what we're going to be talking about today. As Cliff noted, Daria and I are both senior managers in the firm's financial services practice, and together we serve clients out of LA as well as San Diego. We're really excited to have two amazing panelists with us, and together we're walking through the results of the 2018 Global Alternative Fund Survey. To my immediate right is Erin Lavelle, the CFO at Dalton Investments LLC, a $4 billion value-oriented hedge fund manager. And to her right is Stephanie Smith, the chief accountant, as well as a principal at Platinum Equity LLC, the $13 billion private equity manager. Erin and Stephanie, thanks again for being on our panel. Let's get started. We are in the midst of a pretty volatile market environment presently, and the results of our 2018 global survey indicate that to counter this volatility, managers are exploring some pretty dramatic ideas for this traditionally conservative industry. This includes targeting innovation and technology via robotics and automation. It also includes a deep commitment to diversifying the talent base. Over the next 20 minutes, Daria and I will be asking targeted questions of Erin and Stephanie as we explore some of these key themes with a focus on front office technology as well as talent management. Now, the first section we want to cover is the key strategic priorities for firms in our industry. Now, the biggest and most important strategic priority for the managers we surveyed was asset growth. It wasn't fee compression or declining margins. The industry's been facing that for quite some time now as passive managers race towards zero. So with an eye on asset growth, let's dig deeper into that as we get into the next slide. Now, it should be pretty clear from this slide that because of the immense competition for assets, it's become paramount for managers to grow their asset base, even more so than some other important priorities like talent management and front office technology. With net returns not significantly outpacing broad market returns, really the only way our industry can remain competitive against its traditional counterparts is to offer something fresh and innovative. Now, Stephanie, you work for Platinum Equity, an excellent private equity manager, and having worked with you as a service provider for a number of years now, it's been really amazing to see so much AUM growth at Platinum. Now, because private equity has been the darling of the industry with outsized returns compared to its hedge fund counterparts, the number of private equity firms has exploded. In fact, I read an article about the research firm Preqin a few days ago that noted that in 1990 there were 400 private equity firms. Fast forward to today, there's 8,000 private equity firms. That's a 20-fold increase in just the last 30 years or so. Yet, Platinum continues to see robust investor demand. Your latest fund launches are larger than the previous ones. So Stephanie, from the vantage point you have at Platinum, could you comment on asset growth within the private equity industry?
Absolutely. Over the last 16 years, it has continued to grow. Our first fund was $700 million, and our latest, our fourth core fund was $6.5 billion. So it's almost 10 times as large. However, it's very important to know not just to grow your assets, but to continue to have the returns to make that successful. It's not just a matter of getting larger, it's getting larger and continuing to do your core values.
Cool. Thank you, Stephanie. We'll now transition into how else managers can grow assets, and that is to diversify into strategies or investing themes that are not necessarily aligned with the original investment philosophy. And Daria is going to help us talk through that.
Thank you, Govind, and good afternoon, everyone. Investors are demanding customization of their portfolios. So as a result, what we're seeing is that asset managers are offering alternative products in order to appease this investor demand for customization. Investors are seeking to invest in non-traditional offerings. So what we're seeing is private equity, real estate, real assets are some of the major alternative products highlighted in the survey. A majority of the investors responded that they are looking to expand their portfolios with these type of offerings. Stephanie, what are your thoughts on the investor demand for customization, and what have you seen in the PE space?
Our investors for many years have asked us to do some side type investments, like small cap, lower middle market. So our latest fund was a small cap fund. It ended up being $1.5 billion and was oversubscribed, so the demand is definitely there. It's also been recently publicized that we hired a couple of credit professionals to start to really learn more about the credit world. We have some credit investments within our fund right now, and we'd like to sort of expand into other areas.
Great, thank you, Stephanie. Hedge funds are especially essentially responding to this demand by expanding the number of separately managed accounts that they offer. In fact, according to our results, a third of hedge funds responded that they offer or plan to offer funds or SMAs to specific investors. So Aaron, let me shift it over to you. Can you comment on those strategic priorities at Dalton, including a shift into SMAs?
Yeah, so it's actually been part of our strategic core focus to offer SMAs from the beginning. And while we lose some operational leverage there, customizing to the various different SMA components, a lot of this is matching on investment philosophy, liquidity terms, and so on, rather than matching on structure necessarily. So rather than forcing them into a commingled vehicle, if they're the right investor and we agree on investment philosophy, then we've been flexible on SMA and on creating an SMA.
And why do you think investors are interested in investing via SMAs?
Yeah, and so this is a bit of a kitschy response, but we say TLC, and that stands for transparency, liquidity, and control. And so where we can provide transparency to the portfolio, because it's not a commingled product, liquidity terms that, again, match the investment philosophy and match how we invest, and then control. And a lot of that does require that there's stronger communication between us and the LPs, because they're not strapped into a structure necessarily. We believe that it provides us the opportunity to provide outsized returns and really give investors what they're looking for, which is better for both of us in the long term.
Thank you, Erin. I'd like to now shift it over to Govind, who's going to be discussing the increase in the use of technology in our next section.
Thanks so much, Daria. For many years, quantitative fund managers were in the forefront of advancing the use of technology to manage assets. These days, a number of different strategies, including those that employ deep fundamental research, are employing technology to complement the investment process. The reason for that? 2 words: big data. There is so much data available to us these days that we're pretty silly not to use it. Now, to obviously manually sift through all that data is a very cumbersome process, which is where our machine friends come into play, and can really help managers differentiate themselves in a crowded environment. When we surveyed hedge fund managers last year, only 10% said they'd be using artificial intelligence. In this year's survey, 30% of hedge fund managers were either currently using or expect to use AI going forward. Now, private equity managers are still saying limited use, considering the nature of the industry being more hands-on and people-centric versus technology-driven. So I'm going to direct this question more to you, Erin, but I might want to come back to you, Stephanie, because I think you have an interesting perspective here. Erin, you and I have had a great conversation on the use of technology. As innovation lead for my practice in LA, it's been really heartening to see so much robust enthusiasm amongst our junior staff in building customized solutions using the various automation tools that are out there. Our firm's actually spent $1 billion in developing practice-wide turnkey solutions, and so technology is obviously huge for us. Erin, I know that data engineering and data science has been critical to Dalton's success. Could you comment on the quantitative AI tool that your firm has developed that helps front office managers make better decisions?
Yeah, sure. So we are a fundamental shop. We're doing bottom-up fundamental research. And so this solution that we're building is more of what we're calling quantamental rather than a pure quant strategy. We still have low turnover of investments and of trades and so on. But what we're doing is building, with machine learning, building a tool which scrapes key fundamental information, and that helps provide projections and provide ideas of firms that we should look further into. So it's really a screening tool, but it's a screening tool that leverages and takes advantage of a lot of the big data that's out there. So it's something that we're just putting our toe into, but something we're very excited by, because as you said, there's just a lot of information out there, and it'd be silly not to use it.
Great. Stephanie, I did note that private equity managers are seeing limited use of AI, but I think Platinum may be going against the grain here. So do you want to comment on AI within the private equity industry as you see it, Platinum?
Absolutely. Our newest partner is in our transition group, and she goes out to the companies, and a lot of our underlying operating companies are using AI. And so she's developed an IT steering committee at Platinum, which has one individual from each group within Platinum. And we're trying to bring technology into Platinum, not necessarily AI, but technology leading the forefront of Platinum to be able to make the front office and the back office be able to integrate more seamlessly with information.
Great. Thanks so much, Stephanie. We'll now transition into our last section, which relates to talent management, and Daria is going to take us through that.
Thank you, Govind. When we look at the talent profile today, compared to where we were 5 to 10 years ago, it's definitely shifted. And talent management is an area of focus for asset managers in order to gain a competitive edge. Our survey results show that hedge funds and private equity funds have slightly different priorities as they evolve their workforce. Hedge funds are focused on talent with data and analytics experience, while private equity funds are focused on gender and cultural diversity, especially in the front office. So the question arises, are there any talent management programs in place? 84% of investors responded that having a formal talent management program is an important influence on their investment decisions. However, over 50% of hedge funds and private equity funds responded that they do not have a formal talent management program in place. So I'd like to shift it over to you, Erin and Stephanie, to get your insight on this as it relates to your organizations. So Stephanie, let's start with you first. Can you let me know what the talent management program looks like at Platinum?
Absolutely. Diversity is extremely important to Platinum, and so 18 months ago we hired a new head of human resources, and she brings in a diverse group of candidates for all the different roles that we are continuing to hire. As noted, our AUM is growing, and so in the last year we went from 200 people to 250 people, and now we're at the point where we need to integrate all the people into the Platinum culture and the Platinum values.
Erin, how about yourself? Can you comment a little bit about Dalton?
Yeah, so since we are an Asia-focused strategy, one of our key differentiators is having boots on the ground nationals in the countries that we cover. So diversity is already kind of built in, part of our core way of doing business, but it is something that's important to us and something that we're very sensitive to.
Thank you, Erin. I now want to take a deeper dive into investors asking about talent management programs during the due diligence process. Our survey results show that 2 out of 3 investors responded that having a talent program is important. When asked why, there were a number of reasons, and 2 notable ones were 1, talent programs help develop future leaders, and 2, through diversity, they help offer different perspectives within the organization. Stephanie, are you seeing investors ask about talent management programs at Platinum?
Yes, over the last year, in their quarterly diligence requests, I've had a lot of requests for the type of diversity we have in our firm to very specific things: salary sliced across different diversity, the number of people in different areas, and we're still working as a firm to figure out exactly how much information we want to share related to all of that. But that's definitely something new in the last year that I have not seen in the last 15.
Great, and Erin, shifting it over to you, what are you seeing at Dalton?
Yeah, so actually, based on a couple of slides ago, the difference between what investors are asking with regards to PE versus what they're asking to hedge funds, we've seen more questions around talent retention and how we're going about keeping the talent that our investors like and want us to keep there, and how we focus on succession, more than focusing actually on a formal talent management program. But I think some of that might be also just the difference in size between our 2 firms. So we're seeing a lot of focus on talent retention more than actually a talent management program.
Thank you both for your input. It looks like based on the responses, talent management is a trend and a new trend at that, so it'll be interesting to see how talent management programs evolve from where they are today. With that, I'd like to hand it over to Govind for some closing remarks.
Thank you, Daria. So we actually have a few minutes left, so I'm going to bring this last slide up and ask Stephanie and Erin some perspective on this slide, which basically talks about future risks facing the industry. And we've already talked about talent management and technology, but the number 1 risk out here is changing investor preferences. And I'd like to get your thoughts on that. So maybe Erin, let's start with you.
Yeah, and I think this gets back to how do you stay true to yourself while accommodating the complexities and the additional requests from investors. So how do you customize by creating SMAs or by handling those requests while also knowing when to say no? And how do you make sure that you're consistent with your mission, your values, what you're good at in the structure that you're good at, while also saying yes? And so managing between what you're saying yes to And while also hitting those outsized returns, that's the hard thing. That's really what we kind of are struggling with, especially in a fee compression world. So where you're trying to actually build an infrastructure but make sure that it's cost effective and still be good at what you do while also developing and evolving is, I guess that's probably not any new news to anybody in the room, but I think responding to changing investment preferences is a big thing.
Great point, Stephanie. Stephanie, I don't know if you have anything to add to that.
Yeah, I find that lately a lot of the investors want to come into side co-invest vehicles, and a lot of those types of vehicles don't have a fee structure in them. So it's going to be a challenge going forward to be able to appease the investors and give them what they want, and yet still be able to function without the fee structure built in. Also, a lot of investors have requests for much more data. They actually want to be able to go into the systems and pull out the data on your underlying operating companies real time. And I've been at a CFO conference where I asked, is anybody doing this? Because the investors are acting like everyone is. And at that point, none of the CFOs were doing it. So it's sort of a challenge between what the investors want and what we're willing to give. And so it'll be interesting to see. We're actually right now in the process of finding a platform. We're in the middle, actually starts next week, of pulling in some different like E-level and E-Corp and I-level, and there's 8 different groups that are coming in to show us what they can do to have our portfolio companies upload information into a platform that we already gather the information now, but it will be more seamless for the operating companies. And that way we'll have the data, but I still don't think we're ever going to be in the position, at least not in the near term, where the investor can come pull information. It'll just be gathering for us so we can push information to the investor. So, and also I was at an investor conference earlier this year talking about changing investor preferences. I always thought that all the investors wanted us to start to diversify and go into different areas, credit, real estate, whatever it might be. But they were actually starting to say, and I was very surprised by this, that they are concerned that some of the managers are leaving their core and moving into other areas, and that they're going to kind of watch it and see what happens with it. But some of them are actually concerned, and that was the first I heard of that.
All right, thanks so much, everyone. It looks like we are out of time now, but I want to thank Erin and Stephanie again for being such amazing panelists, and to Daria for being my co-moderator. I'll now turn it over to Cliff, who will introduce the next panel. Thank you.